Hello! This is where many stories begin. Strangely, goodbye is not where many stories end. But then, most stories are not about greetings and farewells. Right? They are usually about everything in between. Aren't they? By the way, I am Walter Bright, a CFA coach, a Netflix junkie, and if it wasn't obvious already, a bit of a talker. And I am here to save you from breaking back on your CFA journey. So, welcome to my series on CFA Level 1 preparation from scratch. Now, if you are about to click away because you are not a CFA aspirant, here's the real deal. If you are mildly curious in general, this video will be worth your time. Just think of this as a Netflix docuseries. And then, even though this video lacks what all Netflix shows have in common, you would barely notice its absence. To be clear, I am not talking about engaging content. Trust me, I have got that for you. It's just the skip intro button that's missing. Nevertheless, this is an original presentation. Now, I guess, you are already missing the skip intro button. So, I must conclude my small talk and tell you what this video is about. Well, this video is the first of a 15-part series on economics. Basically, this video is an introduction to economics. So, this is the part that's foundational, intriguing, useful, and yet, simple. There are 5 topics that we roll through. First, we look at the 3 key economic ideas. Next, we look at the economic problem that every society must solve. After that, we explore what economic models are. Then, we examine the difference between microeconomics and macroeconomics. And, lastly, we go through some important economic terms. Now, as is the norm, we begin at the beginning and look at the 3 economic ideas that serve as our basic assumptions in the study of economics. Let me begin by stating the obvious. We live in a world of scarcity, which means that, although our wants are unlimited, the resources available to fulfill those wants are limited. So, to attain our goals, we must make choices. Now, you are probably wondering where economics fits into this scarcity narrative. So, here's the thing, economics is, in fact, the study of choices we make. Formally, economics is the study of the choices consumers, business managers, and government officials make to attain their goals, given their scarce resources. Now, in the study of economics, we make 3 general assumptions which we call the 3 key economic ideas. First among these is that people are rational. This means that people always make rational decisions. Second is that people respond to economic incentives. This means that people behave in ways in which their economic incentives are maximized. Now, our third assumption is that optimal decisions are made at the margin. This means that optimal decisions occur when considering incremental changes or adjustments to existing choices. Let's deep dive into each of these 3 ideas. Economists generally assume that people are rational. But, this assumption does not mean that everyone knows everything or that everyone always makes the best decision. What this means is that consumers and firms use all available information as they act to achieve their goals. Rational individuals weigh the benefits and costs of each action and choose an action only if the benefits outweigh the costs. Yet, it is true that people do not behave rationally all the time. And I don't blame them. After all, if numbers can be irrational, so can people. Now, you might want to ask that if people do not behave rationally all the time, why do we assume so? The thing is that although not everyone behaves rationally all the time, the assumption of rational behavior is very useful in explaining most of the choices that people make. Let's consider an example. Let's say Apple charges $649 for its new iPhone. In that case, economists would assume that the managers at Apple have estimated that this price will earn the company the most profit. But the managers may be wrong. That's a real possibility. After all, the managers can only estimate based on what they know. And, they may not know everything. So, there is a chance that maybe a price of $625 or $675 would be more profitable. Still, economists would assume that the managers at Apple have acted rationally on the basis of the information available to them. After all, they cannot act on information that's not available to them. Can they? What this means is that, when we say that people are rational, we mean that people make the best decision based on what is available to them. Moving on, let's consider our second key economic idea, that people respond to economic incentives. Now, if you have any real experience with life, you will agree that people act from a variety of motives, including love, hatred, envy, and disgust. When economists say that people respond to economic incentives, they do not ignore these other motives. They simply emphasize that consumers and firms consistently respond to economic incentives. Let's consider an example. Once upon a time, it so happened that there was an increase in bank robberies in the United States. In the face of this increase in bank robberies, the FBI officials suggested that banks take steps to improve security. In particular, the FBI officials suggested that banks place uniformed armed guards outside their doors and install bulletproof plastic in front of teller windows. But, surprisingly, few banks took their advice. This is because hiring a well-trained security guard costs about $50,000 per year in salary and benefits, and installing bulletproof plastic costs about $10,000 to $20,000. What's more is that the average loss in a bank robbery was only about $1,200. So, for banks, it was less costly to put up with bank robberies than to take additional security measures. This is how economic incentives work. Now, let's consider our third key economic idea, that optimal decisions are made at the margin. You see, decisions are of two types. Some decisions are all or nothing. For example, when an entrepreneur decides whether to open a new restaurant, she either opens the new restaurant or she doesn't. Similarly, when you decide whether to attend graduate school, you either enroll in graduate school or you don't. But rather than being all or nothing, most decisions involve doing a little more or a little less. For example, if you are trying to decrease your spending and increase your saving, the decision is not really between saving all the money you earn or spending it all. Rather, many small choices are involved, such as whether to buy a Starbucks coffee every day or just once a week. Let's look at another example. Say you come across a series on Netflix. Then, there are primarily two things that you can do. Either you watch it, or you don't. So, this decision is an example of an all-or-nothing decision. Moving forward, let's say you are trying to decrease your Netflix time and simultaneously increase your study time. Then the decision for you is not really between spending all your time on Netflix and spending all your time studying. Instead, the decision is about what to do with the next hour on your hands. Should you spend it on Netflix or should you spend it studying? As a rational individual, you may want to weigh the costs and benefits of each option. So, let's do that. The marginal benefit of spending the next hour on Netflix is the additional fun you receive. And, the marginal cost is the lower grade you receive in your test from having studied a little less. On the other hand, the marginal benefit of spending the next hour studying is the higher grade you receive on your test. And, the marginal cost is the lesser fun that you receive. Now, the question before you is, what should you do with your next hour? If you are studying, should you continue studying? Or, if you are watching Netflix, should you continue watching Netflix? The optimal decision is to continue any activity up to the point where the marginal benefit equals the marginal cost. And this analysis that involves comparing marginal benefits and marginal costs is called the marginal analysis. So, when we say optimal decisions are made at the margin, we mean that we compare marginal benefits and marginal costs to arrive at the best decision. Now, let's consider the economic problem that every society must solve. But first, let's find out how did every society end up with this so-called economic problem that it must solve. Economists tell us that because we live in a world of scarcity, every society faces the economic problem that it has only a limited amount of economic resources such as workers, machines, and raw materials, and so, it can produce only a limited amount of goods and services. Simply put, our economic resources are not limitless. Therefore, every society faces trade-offs, producing more of one good or service means producing less of another good or service. For instance, managers at Apple must choose whether to devote the company's scarce resources to making more iPhones or more iWatches. Similarly, members of Congress and the President must choose whether to spend more of the federal government's limited budget on breast cancer research or on repairing highways. In each case, consumers, managers of firms, and government policymakers face the problem of scarcity by trading off one good or service for another. And each choice made comes with an opportunity cost, measured by the value of the best alternative given up. Formally, the opportunity cost of any activity, such as producing a good or service, is the highest valued alternative that must be given up to engage in that activity. Let's consider an example. Suppose you earn a salary of $100,000 per year working as a manager for Ford. And one fine day, let's say you quit your job and start your own management consulting firm. In this case, the opportunity cost of the labor you supply to your own firm is the $100,000 you give up by not working for Ford. This is even if you do not explicitly pay yourself a salary. In fact, opportunity costs often do not involve actual payments of money. The concept of opportunity cost is an important one. That's because opportunity cost of an activity gives us the best measure of the cost of engaging in that activity. Let's look at another example. Say you have the time to watch either the Barbie movie or the Oppenheimer movie. Now, since you have the time to watch only one of these two movies, the moment you choose one, you give up the opportunity to watch the other. If you decide to watch the Barbie movie, you give up the opportunity to watch the Oppenheimer movie. So, in this case, the Oppenheimer movie will be the opportunity cost of watching the Barbie movie because that is what you give up to watch the Barbie movie. In economics, the best measure of the cost of producing a good or service is the value of what has to be given up to produce it. So, next time when you engage in any activity and wonder about the opportunity cost involved, just ask yourself, what am I giving up to engage in my chosen activity? Actually, you can even go further and ask this question to firms and society as a whole. After all, the concept of opportunity cost applies to all individuals, firms, and societies. Now, moving on, let's look at the economic problem that every society must solve in the absence of unlimited buffet-style abundance. You see, every society faces trade-offs. Due to the availability of limited resources, or more appropriately, due to the unavailability of unlimited resources, every society must make choices when answering the following three fundamental questions. Firstly, what goods and services will be produced? Secondly, how will the goods and services be produced? And lastly, who will receive the goods and services produced? To answer these questions of what, how and who, societies organize their economies in two main ways. They either organize themselves as centrally planned economies or as market economies. But, sometimes, they go beyond and organize themselves as a combination of these two economies and call themselves a mixed economy. Now, let me tell you that economies are like personalities, each has its quirks and peculiarities. For instance, a centrally planned economy is the type of economy in which the government decides how economic resources will be allocated. In fact, the government decides everything, such as what goods and services would be produced, how would the goods and services be produced, and who would receive the goods and services produced. From 1917 to 1991, the most important centrally planned economy in the world was that of the Soviet Union. There, government employees managed factories and stores. So, understandably, the objective of these employees was to follow the government's orders rather than to satisfy the wants of consumers. Ultimately, in 1991, dissatisfaction with low living standards and political repression led to the collapse of the Soviet Union. To be honest, the history of centrally planned economies is quite disappointing. The thing is, centrally planned economies have not been successful in producing low-cost, high-quality goods and services. As a result, the standard of living of the average person in a centrally planned economy tends to be low. Also, all centrally planned economies have been political dictatorships. Today, only North Korea has a completely centrally planned economy, and quite frankly, that's not how an economy should be. But then, it is what it is. Now, on the other hand, a market economy is the type of economy in which households and firms interacting in markets decide how economic resources will be allocated. So, in market economies, privately owned firms decide what goods and services to produce and how to produce them. But, in a market economy, firms must produce goods and services that meet the wants of consumers, or the firms will go out of business. So, in that sense, it is ultimately consumers who decide what goods and services will be produced. For instance, as a consumer, you help decide which goods and services firms will produce when you choose to buy an iPhone instead of a Google Pixel or a coffee rather than a tea. Going further, in a market economy, it is the consumer's incomes that determine who receives the goods and services produced. Overall, market economies tend to be more efficient than centrally planned economies. That is because market economies promote competition among firms and facilitate voluntary exchange. So, in a market economy, you would see firms competing with each other to offer the highest quality products at the lowest price. Also, there's voluntary exchange between the buyers and the sellers. This means that a transaction takes place only when both the buyer and the seller of a product are made better off by the transaction, because, otherwise, the buyer would not agree to buy the product or the seller would not agree to sell that product. One of the other attractive features of market economies is that they reward hard work. In a market economy, the income of an individual is determined by the payments he or she receives for what he or she has to sell. Generally, the more extensive the training you have received and the longer the hours you work, the higher your income will be. And, the higher your income, the more goods and services you can buy. Still, market economies are not as perfect as they seem. You see, who receives the goods and services produced depends largely on how income is distributed. In some societies, there may be severe disparity between the incomes of the rich and the poor. A market economy cannot do much to address this issue. So, in some societies, the government intervenes to make the distribution of income more equal. For instance, in the United States, the government imposes a higher tax rate on people with higher incomes. Also, the government makes payments to people with low incomes. Historically, most democracies, including the United States, Canada, Japan, and the countries of Western Europe, had market economies. But government intervention in these market economies dramatically increased starting from the mid-1990s. This increased government intervention was primarily caused by the high rates of unemployment and business bankruptcies that occurred during the Great Depression of the 1930s. Now, some economists argue that the extent of government intervention makes it no longer accurate to refer to the economies of the United States, Canada, Japan, and Western Europe as pure market economies. Instead, they should be called mixed economies. To be clear, a mixed economy is primarily a market economy because most economic decisions result from the interaction of buyers and sellers in markets. However, the government plays a significant role in the allocation of resources. Now, the answers to the three fundamental questions in a mixed economy depends largely on the extent of government intervention. Moving on, let's look at our third topic, economic models. Economic models, or theories, are simplified versions of reality used to analyze real-world economic situations. Now, the thing about any economic model is that it is based on assumptions because a model needs to be simple to be useful, and assumptions help in this regard. For instance, economic models make behavioral assumptions about the motives of consumers and firms. They assume that consumers buy the goods and services that maximize their well-being or their satisfaction, and that firms act to maximize their profits. Now, these assumptions are merely simplifications because they do not describe the motives of every consumer and every firm. Moving on, let's look at our fourth topic, the difference between microeconomics and macroeconomics. Formally, microeconomics is the study of how households and firms make choices, how they interact in markets, and how the government attempts to influence their choices. On the other hand, macroeconomics is the study of the economy as a whole, including topics such as inflation, unemployment, and economic growth. Still, the division between microeconomics and macroeconomics is not a bright line. That's because many economic issues have both a microeconomic aspect and a macroeconomic aspect. For example, How rapidly an economy grows is a macroeconomic issue and is determined by the level of total investment by firms in new machinery and equipment. But then, to understand how much new machinery and equipment firms decide to purchase, we would need to analyze the incentives individual firms face, which is a microeconomic issue. Some other examples of microeconomic issues include how consumers react to changes in product prices, how firms decide what prices to charge for the products they sell, which government policy would most efficiently reduce obesity, costs and benefits of approving the sale of a new prescription drug, and the most efficient way to reduce air pollution. Now, under macroeconomics, we look at issues like why economies experience periods of recession and increasing unemployment, why, over the long run, some economies have grown much faster than others, what determines the inflation rate, what determines the value of the US dollar in exchange for other currencies, and whether government intervention can reduce the severity of recessions. Now, let's look at our last topic, some important economic terms. First, let's look at the term market. Formally, a market refers to a group of buyers and sellers of a good or service and the institution or arrangement by which they come together to trade. Broadly speaking, in an economy, there are two types of markets: product markets and factor markets. The markets for goods and services are called product markets. Here, goods refer to tangible merchandise, such as books and computers, whereas services refer to activities performed for others, such as providing haircuts or investment advice. On the other hand, the markets for factors of production or economic resources are called factor markets. The main factors of production are labor, capital, natural resources, and entrepreneurial ability. Here, it must be noted that capital refers to physical capital, which includes manufactured goods that are used to produce other goods and services. So, examples of physical capital include computers, factory buildings, machine tools, warehouses, and trucks. In fact, the total amount of physical capital available in a country is called its capital stock. Now, let's look at what a household is. A household consists of all persons occupying a home. Households play a key role in the economy. They are consumers of the goods and services produced by firms. Also, they are suppliers of factors of production which are bought by firms in the factor markets for use in the production of goods and services. For their role, a firm is defined as an organization that produces a good or a service. Most firms produce goods or services to earn a profit. In simple terms, a firm's profit is simply the difference between its revenues and its costs. But then, economists distinguish between accounting profit and economic profit. In calculating accounting profit, we exclude the costs of some economic resources that the firm does not pay for explicitly. However, in calculating economic profit, we include the opportunity costs of all resources used by the firm. Generally, when we refer to profit in economics, we mean economic profit. Now, as you can see, the four key players in an economy are households, factor markets, firms, and product markets. In addition, governments also play a role depending largely on the type of economy we are analyzing. Now that we have come to the end of this episode, I highly recommend that you deepen your understanding by following through on the next episode, that's Introduction to Economics, Part 2. But before that, I suggest you follow the custom of checking your social media accounts and staying updated on who's doing what and where. After all, it makes no sense to have a generation gap with your own generation. And for the gaps that I need to fill in the making on these videos, please do comment and let me know. Cheers!